Hello again. This is Professor Marsh, and this is the sort of the classroom lecture for Unit 9, which is Chapter 8 about fraud, internal controls, and cash. In this chapter, Chapter 8, we're going to learn how to analyze fraud in the accounting workplace, to define and explain internal controls and their purpose within an organization, to describe internal controls within an organization, to define the purpose and use of a petty cash fund and prepare petty cash journal entries, to discuss management responsibilities for maintaining internal controls within an organization. That's something that's become increasingly important after Sarbanes-Oxley and the problems with Enron. And define the purpose of a bank reconciliation and prepare a bank reconciliation and its associated journal entries. And you will have in your homework and in your quiz, you will have to do a bank reconciliation. And so that's one of the key tasks that you learn in this course. If you go to Unit 8A and our comprehensive review, you'll see that one of your other key tasks is to learn the entire accounting cycle and to prepare those three basic financial statements. And we'll learn about the statement of cash flows when we get to the last unit in the course. But a bank reconciliation is a very important statement that you should learn to prepare. And that really is the highlight, that and how to handle petty cash, which there's not too much, to get excited about that. But the bank reconciliation is a very important task, which if you can prepare one, you can tell a prospective employer that you can prepare one. And that's a task that may be able to get you a job. So that's an important thing. And then the last objective is just to describe fraud in financial statements and the Sarbanes-Oxley Act requirements. So let's move on to the first objective, and I'm going to get the chapter right in front of me. So you have an introduction about Jennifer and why this is important, and she decides her college needs a coffee pastry shop and talks to a bunch of people, and they suggest that with the right personnel and with the right systems, that one of the risks that new organizations face is fraud, theft, and violations of internal control policies and principles. And if you set up the right systems, you can avoid that. Well, any system can be defeated. Even if, maybe think about it in this way. Think about the U.S. Constitution and all the checks and balances that are built into the Constitution for our government, so that we have the executive is separate from the legislature, which is separate from the judiciary, and each of them provide checks and balances on the other. The judiciary doesn't exist unless they get appointed by the executive and confirmed by the legislature. That just happened today with the Supreme Court justice. The executive doesn't have any laws to enforce unless Congress passes them. And then if Congress passes laws that the executive doesn't like, they can veto them. And even within Congress, even within the legislature, there are checks and balances, because you've got two houses that represent the people differently, and you have to get the consent of both of the houses of Congress in order to get legislation passed. So there are many, many checks and balances built into our Constitution, and there are certain checks and balances that you need it to build into your business systems, your accounting systems, and your management systems in order to provide checks and balances to make sure that there's not fraud or theft. So that's what we're going to look at in this particular chapter, besides how to do the bank reconciliations, which itself is a check and balance, because then you balance out to what the balance is in your checking account and make sure that you don't have missing funds. Okay, so analyzing fraud in the accounting workplace. And you can see in your book that there's a presentation of some of the factors, some of the conditions that lead to fraud. First, there's a perceived opportunity and an incentive, and then after the fraud, there's a rationalization. And the book calls this, and certainly the literature in this area calls this the fraud triangle. So perceived opportunity, there's some sort of laxness in the system. Okay, that's the first condition. Then there's an incentive to commit the fraud. There's perhaps you might have employees who have financial needs and they kind of find money someplace, and their incentive is they want the money. Or perhaps you go to rationalization. They say, "Well, I'm not getting paid as much as the other person around here, so I'm really entitled to it." So those are the conditions that oftentimes are found to be linked to fraud in an organization. And so you can see the book discusses how many organizations will provide checks and balances to avoid fraud. And one of the key techniques that's used to prevent fraud, or to deter it at least, is to have dual control and separation of duties. In other words, people who are authorized to execute transactions, people who are authorized to send money, sign checks, make purchases, are different than the people who account for them. People who are authorized to purchase materials and inventory are different from the people who keep the inventory in the warehouse or in the supplies inventory. And then different people actually audit and will take care of accounting for that inventory to make sure that it's still there and has not disappeared out the back door, as they say. And those people who check on that situation can be either internal auditors, who are auditors who are employees of the organization themselves, or there can be an external auditor, such as a CPA firm or CPA in private practice, who comes in and works for the company and checks on the situation with respect to the assets and whether the assets are still in place. So that is section 8.1. Let's move on to section 8.2. So defining and explaining internal controls and their purpose in the organization. And you can see the internal controls that can be used. And there's a pyramid that's called the internal control environment that's in your book in figure 8.3. And it's worth taking a minute to just take a look at it. And you see, starting at the base, you've got accurate communication of information. That's important. If you don't have accurate communication of information, then there might be an opportunity for fraud if you can't sort out the wheat from the chaff in your accounting system. You need to have accurate communication. Monitoring of control processes, control of operational activities, assessment of risk. Now that's actually risk assessment. Is a position which has grown in importance in many organizations, particularly larger organizations. You'll see risk assessment officers in virtually every large public company, and often a staff of many people. That can provide employment for many people. And you don't have to be a CPA to be a risk assessment officer. It's a different function than auditing and verifying financial statements. It's a little bit more almost like being a detective. It's somebody who's interested in in other words, they kind of have to think like the bad guy. If I was a bad guy and was trying to cheat, how would I do it? And then that helps you assess where the risks are. And there's other financial techniques that are used to assess risk also. So there's it's not just specifically looking for fraud. It can be other types of risk as well. And then control of the environment. So those are the internal controls. And the system of internal controls is the policies combined with procedures created by management to protect the integrity of assets and ensure efficiency of operations. And the system prevents losses. Pardon me. Yep. Sorry. Excuse me for just a second. It is a beautiful spring day. There's a lot of pollen in the system. Okay, so the system prevents losses and helps management maintain an effective means of performance. And my experience with internal controls began quite early in life. I started working as a bank teller when I was still a teenager at a bank, Citizens First National Bank up in New Jersey, which no longer exists. It's been bought out by a big bank, as a lot of the other little banks have been bought up over the years. But when I was there, I started as a drive-in teller, and every day, at the end of the day, I would have to do a reconciliation worksheet for all the activity at my particular drive-in window. And so I had a cash drawer that had maybe $15,000 or $20,000 in it, and I would use that money to cash checks, to take in additional deposits, to make change, and that sort of thing. So I would, at the end of the day, have to calculate all the cash transactions that I had and make sure that my beginning balance at the beginning of the day and then the transactions that I had processed after that adjustment equaled the cash I had at the end of the day. And if I didn't do that, then I had a difference ticket. And so after that experience, I went off to college. I think I worked for the bank a couple of additional vacations. And then after I graduated from law school and business school, I worked for First Union Bank in their financial consulting department. And while I was there, I worked on a project designed to demonstrate compliance within First Union Bank with the Foreign Corrupt Practices Act. During the 1970s, there had been a number of financial scandals that involved companies paying bribes overseas, making illegal political contributions, particularly as part of the Watergate scandal. And so Congress enacted a set of laws requiring that all public companies have a good set of internal controls designed to defer and to deter, and not just defer, but deter, and also to identify possible fraudulent transactions. And so I had to write internal control questionnaires, and the first one they gave me to write was for the teller line, since they knew I had been a teller in the past. And then I also did similar controls for the various departments in the wealth management and also in some of the other departments as well. I think the tax department and a few others. So in any event, it's been an important concept for a long time, and you do have to know about internal controls for purposes of the CPA exam. So let's go on to 8.3. And again, you should just read this and learn this and learn enough to answer the homework and to do any quizzes that we have for this particular section. And I think I'll do one that combines the last two units that I'll post tomorrow. But internal controls within an organization are principles of an effective internal control system include having clear responsibilities, documenting operations, having adequate insurance, separating duties, as I said before, either two people in control over any cash, and having different people responsible for executing the transactions, and then recording them and accounting for them. And then internal controls are applicable to all types of organizations. So it can be for-profit, not-for-profit, and also governmental organizations. Internal controls are the checks and balances within the accounting and management systems of a business. Okay, let's look at the petty cash fund. I want you to read this and I want you to learn this, but I don't think I really need to explain it all that much. Petty cash I always think of as just like that little cash box that a lot of businesses have when they need money to go out and pay for, I don't know if they pay for stamps or pay for lunch or that sort of thing. So if you buy a roll of paper towels in order to clean up the office kitchen or something. The purpose of a petty cash fund is to make payments for small amounts that are immaterial, such as postage, minor repairs, day-to-day supplies. Petty cash account is an impressed account. That's an important term, an impressed account. So it is only debited when the fund is initially established or increased in amount. And the transactions to replenish the account include a debit to the expenses and a credit to the cash account. And you can have a transaction to increase the account. So that would be a debit to the account. And the book gives an example of increasing it, from 75 to 100, or what happens if you want to decrease the petty cash account, and what happens if you find a shortage. If somebody's taken $5 out to have lunch and not recorded it. Well, that's sort of like the broken windows concept in law enforcement. I'd be concerned if I was finding cash shortages in the petty cash drawer, but you can do a cash over and short ticket to adjust the account and to replenish it if there's a cash shortage. But if it happens too often, as the book points out, you should be concerned, so I certainly would be. Okay, so under Sarbanes-Oxley, and this is described in your book in some detail, the chief executive officer and the chief financial officer, these two officers that are in every public company now, chief executive officer, CEO, and chief financial officer, CFO, two top people in the C-suite in a corporation, they have to certify that they've reviewed the internal control report provided by the auditor and that the report does not contain any inaccurate information, and they believe that all financial information fairly states the financial conditions, income, and cash flow of the entity. And that makes the CEO and CFO personally responsible for financial reporting as well as internal control structure. See, in the past, the CEO or CFO might say, well, the auditors gave us a clean report and we didn't know any different. They figured they were the experts, so why are we responsible for all this fraud that's taken place in our company? So that was not successful as a defense in Enron, but Congress, never missing a chance to overcompensate, has now made this a requirement for all public companies when they report to the Securities and Exchange Commission. So in any event, you do have to take it seriously, and while the personal responsibility of those two key officers seems to be draconian, and you might consider whether you would want to be one of those two key officers in the entities in which you might become affiliated. Nonetheless, it is the buck stops somewhere, and in this case, it stops with those two key chief officers. So there we go. Okay, let's move on to 8.6. 8.6 is the bank reconciliation procedure. Now think of it this way. You have a bank account and you write checks and you make deposits, and you know about all that. You know when you do that. You know when you write a check to somebody. You know when you make a deposit. And you should write that down in your checkbook every time you do that. So you keep your balance of what you know is in your bank account. But then at the end of the month, you get a statement from the bank. And the bank tells you what they know about your account. And so they show you the deposits that were made, the checks that cleared, and they also typically have a couple of other adjustments to your account. One is they might charge you a fee, okay, which you don't know about, or maybe you know what it's going to be, or maybe you have a no-fee account, which would be great. Then you don't have to make that adjustment. Then the second thing is they often credit interest on your account. And so they calculate what the average balance has been, and they pay interest based on whatever method they use to pay interest. And it makes a difference how they do that too. And they will tell you what your balance is at the end of the month. And you might say, well, it's different than what's in my bank book, and it might be different because the bank has charged a fee and credited interest. And if it is, when you get your statement, you need to put those adjustments into your register. You need to put those into your bank account. And of course, as accountants, we would make those as entries into our T account for cash. So we would make those entries. The charging of a fee would be a credit to cash if the bank charged us a fee, and the paying us interest would be a debit to cash, and the credit would go to interest revenue. So that's what we'd do on our side. But then to do a reconciliation, what we'd have to do is take the number that the bank gave us, and there might be deposits in transit that the bank doesn't know about at the time that they sent the statement, and there might be outstanding checks. We might have written a check to somebody who hadn't cashed it or deposited it yet. And so we have to make those adjustments to the bank statement. And then when we make those adjustments, at that point, then the two balances should equal each other. And that's figure 8.6. Okay, that process is explained. Excuse me. Awful pollen today. In figure 8.6. And then you can see an example of it for this feeder plumbing company as of July 31st, 2018, in the little orange example that's in the next part of your chapter. And that's a good bank reconciliation. You should learn this statement. This is an important statement to learn how to prepare, just as the Unit 8A comprehensive, global comprehensive example was. If you can do that, if you can do the bank reconciliation, then you've mastered a couple of the key techniques that you need to learn from your accounting course if you're going to take it out into the community and work for an organization. So this is very important stuff. And with that, you can see some of the journal entries and how to make those journal entries. That concludes 8.6. With respect to the rest of Sarbanes-Oxley and how companies cook the books to misrepresent its financial condition, I've talked about it before, but I really like the presentation after the example of Health South, and right underneath that little gray box that they have about Health South and their fraud, you have the inventory manipulations and how inventory accounts can be used to overstate income. and they have all these things. One is called channel stuffing, encouraging customers to buy products under favorable terms. You can have sham sales, sales that have not occurred and for which there are no customers. Bill and hold sales, recognizing income before you've got the actual transfer to the buyer. Improper cutoffs, recording sales in the wrong period to try to, again, accelerate revenue recognition. And round tripping, which as a baseball fan, I like that name. Round tripping, selling items with the promise to buy items back, usually on credit, so there's no economic benefit. And I think we had an example of that in a previous chapter. And you've got an example of Enron, and we've talked about that before, but it's worth reading it. Certainly, Enron is something that all accountants, all auditors think about on a regular basis, and particularly if they have any suspicion that they're working with somebody who has bad internal controls, or perhaps has some people who are ill-intentioned and committing fraud. So I know that's a quick explanation of what we are doing in this particular unit. The key thing to focus on as far as your takeaway from this chapter is the bank reconciliation. Please learn that and learn that well. And with that, I'm going to say goodbye for now, and we'll see you next unit next week. And please feel free to come by on Friday mornings. I'll be at the Kaufman Dining Hall again from 9:30 to about lunchtime. So please feel free to stop by if you're having any problems or have any questions, and say hello. Thanks a lot, and have a great day. Bye-bye.